Picture Madrid in the summer of 2025. A couple walks out of a viewing. The apartment is smaller than they hoped. The kitchen needs work. The building has no elevator. The asking price is still high, and the agent says the line everyone keeps hearing right now. If you like it, you need to move fast. There are 3 other offers, and one of them is ready to sign today. Now picture the bank, not the branch, the back office, files stacked, appraisals, underwriting, calls, emails, more requests than they have seen in years. Because in the first half of 2025, Spain recorded about 396,000 mortgage operations. That is a historic pace, and the year is projected to close near 800,000. In other words, a record year for buying homes and signing mortgages, right when the rental market is tense, prices feel stretched, and buyers feel like they are competing with everyone at once. So here is the question that matters. Is this a housing bubble? The honest answer is no, not in the classic sense. But it is also not calm. It is not balanced. It is not healthy. It's not a bubble, but almost. It is an overheated market. And if you are planning to buy, negotiate a mortgage, or decide whether to wait until autumn, you need to understand what is actually happening beneath the headlines, because the risks right now are not just prices. The risks are speed, pressure, and the fine print. Let's start with the big picture. Housing has 2 markets that feed each other: renting and buying. When renting becomes too expensive and too unstable, people do not just complain. They panic. They move from renting to buying, not because buying is suddenly cheap, but because renting feels like a trap. And in 2025, many renters are experiencing sharp increases at renewal, fewer available listings, and more requirements from landlords. The result is predictable. A wave of demand shifts into the purchase market at the same time. That demand hits a market that already has limited supply in many areas. Not enough new housing, not enough available listings where people actually want to live. So prices do what prices do when demand outruns supply, they climb. And the higher they climb, the stronger the fear becomes for buyers, because every month feels like it costs more. This is how markets overheat, not always through irrational lending, sometimes through rational fear. Now add the interest rate layer. Most Spanish mortgages are linked to Euribor, and by mid-2025, Euribor is around 2.66%. That matters because the direction feels downward compared to the worst moments, but it is not low like the decade people got used to. It sits in a zone that feels more stable, and stability changes behavior. When rates stop moving violently, people stop waiting. They act. If the European Central Bank holds rates relatively steady through the summer, we may see a similar pattern to late 2024, when Euribor stayed in a narrow band for months. That kind of plateau creates confidence. Not because life is suddenly safe, but because people can finally make calculations without the floor shifting under them every week. This is why the second half of 2025 may feel calmer in rate headlines, even if the housing market stays hot. And now we get to the part that most buyers misunderstand. When mortgage volume surges, you might assume banks will compete aggressively. You might assume banks will start a price war to win customers. That is what many people expect. But a bank is not just trying to win. A bank is trying to manage capacity and profit. When banks are overloaded with applications, they do something that looks unfair if you are a buyer. They become selective. They do not need to give away margin to attract more volume, because the volume is already there. So what happens is this. The best deals become reserved for the best profiles. And in banking terms, a best profile usually means your debt-to-income ratio stays below about 35%. You have stable income, clean history, and the loan makes business sense for the bank. There is another detail that matters in Spain. The bank covers most of the mortgage constitution costs except the appraisal. That means the bank wants loans that are profitable enough to justify those costs. In practice, many banks are more interested in larger operations. If the mortgage is above 200,000 euros, you are more attractive to the bank. Not because you are better as a person, but because the economics of the deal often work better for them. This is why some buyers are having a strange experience in 2025. The market is full of buyers. There are records. Everyone is signing. But negotiation feels harder. Not because banks are refusing everyone, because banks can afford to say no or offer less friendly terms and still have a full pipeline. Now let's talk about the most dangerous part of an overheated mortgage market: too good to be true offers. You have probably seen headlines or ads that say fixed rate mortgages at 1.65% or even 1.6. And if you are a buyer under pressure, those numbers feel like a lifeline. But the interest rate is not the mortgage cost. The real cost is the annual percentage rate, what many people call APR. In Spain, you will hear TAE. This is the number that attempts to include the linked costs and conditions. It is not perfect, but it is closer to reality than the raw interest rate. How do banks offer an extremely low fixed rate in a high-demand market? They attach conditions that make the deal profitable in other ways. For example, those ultra-low rates may be limited to new build properties above 300 or 350,000 euros. They may require high salaries, sometimes combined household income that easily exceeds 5,000 euros monthly. They may be limited to very specific profiles. And even then, they often include aggressive bundling. This is where buyers get trapped. The bank is not only looking at your mortgage payment, the bank is looking at 25 or 30 years of relationship, your payroll deposits, your home insurance, your life insurance, your cards, your funds, your pension products, your fees. And if a mortgage has a very low interest rate, the bank often expects to earn the margin somewhere else. That is why you must look at the full picture. Ask for the cost of the home insurance, ask for the cost of the life insurance, ask whether the premium is annual or a single premium, ask how many years you are locked in, ask what happens if you cancel, ask what fees you pay if you move your payroll, ask what maintenance commissions apply, ask for everything in writing. Because the most expensive mortgages in this market are not always the ones with the highest interest rate. Sometimes the most expensive mortgages are the ones with the prettiest interest rate and the ugliest fine print. There is one specific tactic that has returned in overheated markets: single premium insurance, sometimes financed inside the mortgage. Here is how the trap works. You think you are borrowing 200,000 euros, but then a large insurance premium is added, maybe 10,000, maybe 20,000, sometimes more, and it gets financed over the full term. Now you are paying interest on an insurance product for decades. The bank earns margin on the product, margin on the financing, and you feel like you won because the interest rate number looks low. This is why you cannot evaluate a mortgage by the monthly payment alone. A lower payment can be engineered in ways that cost you more long-term. A slightly higher interest rate with simpler conditions and cheaper insurance can be the better deal. In the current market, many competitive fixed-rate offers that actually make sense for normal buyers often land somewhere around 1.75 to 2.2% depending on profile, loan-to-value, and conditions. If you are financing 90 or 95%, the pricing can be higher, and that is normal. The key is not the headline. The key is the total cost. Now let's shift from mortgages to the housing market itself, because this is where the title makes sense. Why is it not a bubble? A classic bubble usually includes a few ingredients: easy credit for everyone, loose risk standards, speculative buying with the expectation of fast flips, buyers taking loans they clearly cannot afford, a sense that prices only go up and fundamentals do not matter. In Spain today, you can argue that prices are stretched and emotions are hot. You can argue there is fear of missing out. You can argue there is overheating, but the banking system is not behaving like it did in the worst bubble era. Banks are not simply giving mortgages to anyone with a signature. They still care about your payment capacity. They still use risk criteria. They still look at debt to income. In other words, the credit quality component is not as reckless as a true bubble. At the same time, prices are being pushed by structural pressure, limited supply, high demand, rental stress, and a cultural shift where many people who rented comfortably for years now feel they must buy because renting has become unstable. That is not speculation, that is forced demand. And forced demand can heat a market to dangerous levels even without reckless credit. So the risk in 2025 is not necessarily a sudden collapse triggered by bad loans. The risk is something more personal and more common: overpaying because you rushed, buying the wrong property because you panicked, signing the wrong mortgage because you fixated on the interest rate, losing your deposit because you signed before doing due diligence. This is why the advice that matters right now is not just about forecasting Euribor. It is about slowing down your decision process even when everyone is trying to speed you up. If you are buying, treat it like the biggest contract you will sign for years, because it is. Do not sign an earnest money agreement in a rush. Do not commit without reviewing the property situation. Get the land registry information, confirm ownership. Look for liens. Look for embargo notes. Confirm whether there are inheritance issues. Confirm whether the property has any special protection status that affects resale. Confirm whether rights like preemption and redemption apply in your region. Confirm whether there are community debt issues. Confirm the legal reality, not just the photos. Because one of the saddest patterns in a hot market is the buyer who pays a deposit, then discovers a problem, then cannot close, then loses the deposit. And it happens more often when people feel pressure. Another pattern is regret. A buyer signs because they fear missing out. Then they find a better option. Or they realize they bought too high. Or they realize the neighborhood does not fit their life. In a calm market, you have time to think. In an overheated market, thinking feels like a luxury. But skipping it is expensive. Now let's talk about what you can realistically expect after September into the last part of 2025. On the rate side, unless there is a major surprise in inflation or geopolitical tensions, you are likely to see more stability than in the first half of the year. You might see gradual downward pressure, but not aggressive drops. If you are waiting for Euribor to instantly fall below 2%, it could happen eventually, but it is not something you can assume on a schedule. Historically, Euribor has spent long periods above and below certain levels, and the long-run average since the early 2000s sits around the 1.8 zone. That suggests 2.6 is not crazy high, but it is also not the ultra-low world people remember. On the housing side, prices can keep rising if supply stays tight and demand stays intense. Even if rates stabilize, buyers remain motivated because the rental alternative feels worse. That is why you can have a market where everyone complains it is expensive, and yet transactions keep climbing. And this is where the market becomes almost bubble-like, not because lending is reckless, but because behavior becomes reckless. People start buying any home in any condition at any price just to stop the pain of renting or the fear of waiting. That is how individuals get hurt even if the market does not crash. So what is the smart move if you cannot afford your dream home right now? There is a strategy many people ignore because they think it sounds like settling, but it is actually how many households built their position over time, enter the property market with something smaller and manageable. Not the perfect home, not the forever home, something you can afford without breaking your life. Something that can hold value, possibly appreciate, and help you build equity instead of paying rent forever. For some people, that might mean a smaller apartment. For others, it might mean a property in a less central area with better fundamentals. For some, it might even mean buying a parking space or a storage unit or a small investment property if living in it is not possible. The point is not to impress anyone. The point is to join the circuit, build equity, and give yourself a path to upgrade later. In an overheated market, this can be the difference between a strategic step and a financial trap. Because the worst decision is stretching to the maximum, financing 100% because you feel forced, and then living with no margin. If anything goes wrong, job loss, health issue, unexpected cost, you have no room to breathe. And the bank does not care that the agent said it was now or never. So here is the real summary. The second half of 2025 may bring slightly cheaper mortgages and more stable pricing in loan offers, but banks will remain selective because volume is high. Housing prices remain out of balance and may continue rising because supply is tight and rental stress is pushing buyers into purchases. There are no obvious signs of a classic bubble driven by reckless credit, but there are clear signs of overheating driven by pressure and emotion. And that is why the title is true. It's not a bubble, but almost. Not because the whole system is about to collapse tomorrow, but because the atmosphere is hot enough to make normal people make abnormal decisions. If you buy with a process. Check the property properly, check the contract properly, check the mortgage total cost properly, ignore the headline interest rate, and focus on the APR and the linked product costs. Do not let a low number distract you from a high long-term bill. Do not let fear push you into a home you will regret. And if you cannot buy the dream home right now, do not interpret that as failure. Interpret it as strategy. Enter smart. Enter smaller. build equity, build options, upgrade later. Because the goal is not to win a bidding war in a hot year. The goal is to own a home and a mortgage that still feels safe when the market stops being kind. This content is educational and general. Always evaluate your situation, your risk, and your long-term budget. And if needed, consult qualified professionals before signing a property contract or a mortgage.